very warm welcome to everyone. I am Shrija Agrawal and with me is a very special guest today. With me is Neelkanth Mishra, who is the Asia Pacific strategist for Credit Suisse. Neelkanth, thank you for talking to us and welcome to Mid Insights. My first question really to you is that 2018 was a year when we saw volatility on many fronts. There was a interesting cocktail mix of macro factors. And even back home, we had quite a few things in terms of the IL&FS crisis that we saw, or the so-called Black Tuesday it was. As we leak into 2019, what do you think are the 3 or 4 recurring themes that people will talk about? And also looking back, how would you scale 2018 in terms of reforms?
So globally now, after a 2-year period of seeing persistent upgrades to global growth forecasts, we are now starting to see them being tempered, and I think that process will continue. The second big event that started in 2018 was the shrinkage of global central bank balance sheets. So they had been rising very steadily from 2007-8 onwards to 2018. That process will continue. In the next 12 months, we'll see $430 billion of erosion, and over the next 2 years, about $900 billion. I don't think the global markets are fully prepared for this, just as the increase in the balance sheet size was very unconventional. I think it will take a lot of adjustment for all asset classes as those balance sheets start to shrink. For the central banks to change their guidance on this pace of shrinkage, as well as on what they do on interest rates, you will need to see a lot of stress in financial markets. So I expect that this will not be a very smooth process. I don't expect really a crisis somewhere, but I think there will be a lot of uncertainty and a lot of volatility in 2019.
Interesting. You mentioned that we are perhaps used to this easy financing regime, and which is why a lot of capital was coming in. And perhaps all asset classes looked really good because of that. So are you hinting at that a lot of other asset classes will actually be affected in a very deep fashion because of this?
So we saw that already in 2018. So almost every asset class, bonds, equities, commodities, everything has seen a correction globally. And I suspect 2019 won't be any different.
Mm-hmm. We've always spoken to institutional investors, and I think some of the last sound bites that we received from them is that India is proving to be a very expensive market, And in fact, I met Mark Machin, the president of CPPIB recently, and he said that's the highest P multiple in the world. When you speak to institutional investors, give us some on-the-ground sense of how they're looking at India right now, and when you speak with them, what are their concerns playing out in their mind?
No, India has become a very expensive market. Part of it is because the global markets are very expensive. So India price to earnings versus world price to earnings, what we call the PE premium. In 2007-8, it was 80%, so it was ridiculously high. At the peak in 2010, it was about 40-45%. In the last 7 years, 2011 onwards, we have seen this peak at 35. Last week we were at 28, and given what has happened globally, the markets are down, India is up. I'm sure we are heading close to that peak. So India is very expensive, especially some of the stocks that have reasonable prospects are very expensive. So the objective for investors, in my view, would be to find stuff which is relatively reasonably priced and still has good prospects. And just to add to the first question on the reasons for global volatility, another thing that has changed is that the regime of increasing openness. See, in the last 20 years, we have all gotten used to not just lower interest rates, but also increasingly open worlds, increasing interconnectedness in financial and economic markets. And this is the first time that we are now starting to see a pushback towards that. And it again won't be a smooth process because it is disruptive, because the politicians who are taking these decisions are also aware that it is disrupting their markets. So while there is a geopolitical reason for two countries, large countries, to sort of slug it out, it is going to disrupt both these economies as well. So it will not be a straight line process, but the uncertainty is now being introduced, and that's not generally good for markets.
Okay, so I see a sense of concern from whatever we have spoken till now. You spoke about geopolitical concerns, you spoke about this entire tap of easy capital being shut down. If you were to give me what would be the three clear implications for that in 2019, perhaps the first half and then the middle term and the long term, how will that scenario play out? What would that be?
In the Indian market, certainly.
Yeah.
So, I think the first thing is that global price to earnings multiples will be questioned. I think that the equity prices globally are very high on any measure that you look at, right? So the last 10 years average PE or forward PE or whatever, I think that is something that will be questioned because it's not just about the benchmark yield, say the US 10-year, but also the equity risk premium. So if there is greater uncertainty, then the premium that equity investors desire will be higher. India can't be immune to that. I think there will be. I think that's something that we have to get used to. And the fact that we could see a correction as well because the premium can't keep expanding.
Okay, so has India attractiveness waned in the mind of institutional investors?
Okay, it depends on the type of the investor, right? So if you are a 5-10 year investor, I don't think anything much has changed, right? So in the last 25 years. We have grown at nearly 7% GDP.
But growth is slowing down comparatively, 6.5%, you say.
It is possible in the near term it can do that, but see, 6.5% is a very strong growth. I mean, it is much lower than what we should aspire for.
Yeah.
As an economy, we need to grow double digits, right, to get people out of poverty fast enough. But 6.5-7% is not growth that you see anywhere else. And it's a large economy now, it's $2.5 trillion. So we are adding, in the next 10 years, based on, how fast China slows, we could be adding, 10-15% of incremental GDP in the world. And that's a lot. And no investor would want to avoid that space. So for the long-term investor, I don't think anything really changes. And it is reasonably immune to political cycles as well. In the last 25 years, we have seen, coalition governments, unstable governments, 4 governments in 3 years and stuff like that, and sort of governments with absolute majority as well. Nothing much has changed. So I don't expect that to be very different. For the near-term investment decisions, I mean, someone deciding, so if you're an emerging market fund and you're deciding whether it should be 8% in India or 6% or 10%, because 8% is the benchmark, that's where these price to earnings decisions start to make a difference. But at this stage, I would be, and I think the interesting problem for us all to solve is how long do the domestic inflows continue to at this pace? Because even in good years in the past, $20 billion of FII flows was actually considered very, very high.
True.
But now domestic flows are actually 20 billion or higher every year.
So that's a good sign.
It's, I think, a good sign. It is a good. It's a sign of financial savings starting to go up. It is a sign of people becoming more aware. It is very well distributed. It is 25 million folios putting in 3,000, 3,500 rupees a month, which is very, very healthy quality. But at the same time, it is a herd, and a herd not in a negative sense. I mean, it's a big crowd. It's very hard to predict their behavior. At what point they turn is something which is at least this stage not very clear.
Interesting, Neelkanth. You also mentioned about this fact that there's also one big risk of the regime changing. 2019, there's a huge confluence of markets and politics that will play out. Can you perhaps give us a sense of what is market expecting?
If there is a change in government in India, and I think, and then this we have written extensively on, that if you plot the Nifty, so this is the midpoint, this is the day the election results get announced, you plot the Nifty 180 days prior to that and 180 days after that. You really can't. If I hadn't told you that this is where elections happened or election results were announced, you wouldn't be able to say elections happened. So I don't, in the markets, especially the Nifty or the BSE 100, I don't really see a sustained shift in market direction because of elections. Partly because many of our large cap stocks are actually not fully about India. So 55-60% of our revenues in the Nifty are outside India or are linked to outside India. So there are IT pharma companies, of course, large automakers, there are refiners, there are metal companies where the prospects are determined more or less by what happens in China or the rest of the world. Most companies have a significant export element. So by itself, fundamentally, that's one. Secondly, even in the domestic space, so if say private banks are 2/3 of the banking market cap, but they are only 25-30% of the market share in credit, and 20% growth for them is reasonably sure because they are gaining market share, they're much more competitive than PSU banks. So people are not going to change their view on a private bank just because the government changed. So for the market as a whole, the regime, there will be noise. I think, we are seeing that. So there will be a lot of noise and dust, but not that much of a meaningful change in direction.
Okay, interesting. Then there's one thing, Neelkanth, this entire story about India consumption story being the investor's magnet. Do you think that will continue to happen?
Yes and no. Yes, in the sense that these companies have continued growing in high single digits, low double digits for 15, 20 years. They are extremely well-managed companies who adapt very well, very smart people running these companies. I don't see that changing. So if nominal GDP growth is at 10, 11%, there's no reason why they cannot keep growing at 8 to 10%, maybe some bit 12, 14%. The question is, as stocks, will these do well? Right? And so most of them are trading at price to earnings multiples premium to the market, which is at an all-time high. And an all-time high does make an impact, right? And plus, I think the projections over the next 3 years, so I think as companies, of course, companies are theoretically forever, right? The projections over the next 3 years are anchored to what's happened in the last 12 months, which I think is perhaps too optimistic, because what people forget is the cycle of the pay commission in India, where almost 3 crore people, pensioners or salaried people, working for state, central governments and central public sector enterprises.
That's interesting. That will add more to the consumption story.
That had added a lot more to the consumption story, and that's fading now. So the 7th pay commission was effective 1st January 2016. The central government started it on 1st April. Allowances happened 1st July 2017. Most states are now done. Maharashtra is going to be the last one starting 1st January. This in toto has added about 450,000 crores annually. Now imagine that this is almost 2.5-3% of GDP over the past 3 years. And the impact of...
That's fading out now.
It will fade out now. So extrapolating what happened in the last 3 years to what's going to happen in the next 3 years is, I think, the mistake that the market may be making.
Thank you, Neelkanth. Thank you so much for talking to us. Thank you so much.